Tesla is up another 2.5% today, and price action is looking very, very good. On top of that, we have triggered once again another alpha gold flow for Tesla, which means there is a ton of unusual call buying opportunities that is happening in the market. You can see today, confirmed bullish action is $32.43 million in call options for Tesla. This is a very good sign. Now, the biggest difference that we are seeing between call buying today and that alpha gold alert today versus the 40 million that we talked about last week is that this is dispersed across multiple different orders. So there are basically two ways that these unusual orders happen. The first is going to be an alpha gold alert from a large flow. This is going to be one massive order across maybe a couple of minutes. That's normally going to be one specific buyer. This is the one that we covered from our Discord community last week. You'll normally see where it's about 10, 20, $30 million coming into one specific order within about 10 to 12 minutes. Now, the other type is where we have a ton of smaller call buying that happens. You can see here a bunch of small repeater bullish flow, rapid fire bullish flow for different dates. In this example, 9/12 360s, 8/29 355s, 2/20/26 550s, where the accumulation of all of these buys hits a certain criteria. In this case, it was about $32 million in confirmed flow. Now, if you want to learn how to actually read the unusual options flow, go ahead and check out our free courses down in the description and start with the options flow mastery course. And if you're somebody who is learning how to actually trade options responsibly, learn how to price an option, which contracts we should be looking at from a responsible standpoint, and more importantly, what the Greeks mean, you can also take our options trading simplified course completely for free. Now, this is just more evidence of a potential breakout to the upside. When we have basically our technical analysis and our strategy telling us that the stock is going to break out, and then on top of that, we have a lot of unusual options buying in the options market, this is basically more evidence and a bigger chance that this breakout is going to happen. And of course, we could be wrong, right? This price action could end up rejecting. We could see this pull back. But to be quite honest, I think there's probably about a 75% chance that this breakout is going to happen. Currently in our January calls 2026 with an a strike price of $340. So my call options are number one, already in the money by about $4, which means they already have intrinsic value. And on top of that, we have about 4 to 5 months until expiration. Now, my personal plan here for these call options is that if price breaks through this volume resistance that we've been talking about for the past couple of weeks and runs right up to that $400 target, I am going to start rolling out my position. Now, if you want to learn more about rolling positions, go and take the free options course. But basically what this means is that as price is breaking out, let's say price over the next couple of days moves its way up to $370. Because I have a $340 strike price, I have a safe options contract. But what I personally want is to have an option that is normally always at the money, because since I'm trading with more size, I want to have a contract where people want to actually buy it from me when I am ready to sell. And I want that option to have high volume. And in order for it to have high volume, it normally has to be closer to the strike price. I've been doing this with AMD, this entire breakout to the upside. If we actually go and just take a look at my AMD positions, you'll see the last time that we rolled a trade was back here on August 13th, where I ended up closing out $170 calls for a $21,000 profit, and then ended up rolling them into $200 calls. We go back to July, you can see here on the 15th, I rolled out $140 calls and opened $160 calls. On the 28th, I closed those 160 calls, bought the $170 calls. The reason that we do this is because as the stock is breaking out, like I said, we want to have an options contract that is always near the strike price. Because think about it this way, if we get up to that $400 to $500 target that we've been talking about, how many people are going to want to buy a $340 call contract from me? Very little, right? Nobody's going to really want to get a contract that's $60 in the money. So if we continue to push up, most likely to $370 or $380, I will probably close out that position, realize the profit, then take that capital, the excess capital from that trade and the principal, and roll it into another call option for January, but this time instead at $380 or maybe a $400 strike price. That is how you responsibly manage an options position. You don't want to go buying a $400 call right now because, yes, if price breaks out aggressively, you'll make a lot of money. But if we continue to squeeze like we have been, then you're holding something that's like $60 to $70 out of the money, and the theta decay is going to eat away at that. And it's just not going to be ideal to be trading it. So that's my actual plan for the options that I'm currently holding. Now, as far as targets, we've talked a lot about this, but for anybody who is new trading this setup with me, let's go over these briefly. The first target and the main target that I'm looking at if we break through $350 is going to be right at 400 bucks. Now, there's a big reason for this, right? Number one is going to be because we have this block here on the volume profile. Now, the volume profile is this gray indicator here on the right side of your screen. This indicator is going to show you exactly where shares have been bought and sold in the past. Now, if you want to get access to this specific THT volume profile, go to our free courses and check out the volume profile blueprint. You will get a 20-minute lecture showing you how to set up the indicator and my exact requirements for getting into and out of positions with this indicator. Now, where we have thick areas of volume on the volume profile, these tend to be strong resistance levels and strong support levels. So you can see here that between 320 to 330 has been a major support and resistance level. This is also why we averaged down a couple of days on our calls because we thought price was going to bounce. So I do think that if we're going to reject, it will probably be around $400. The other reason that I have this target here is because there is a gap back here from February. Now, in technical analysis, there is a saying that all gaps fill. That is not true, but probabilities state that most gaps will fill. So in most cases, if price actually breaks out, we will fill that gap to the upside, which also correlates with $400. Now, from that point, I think there's a pretty good chance price will reject short term. But if it doesn't, then we have to move out into our weekly chart. If we move out to our weekly chart, you are going to notice once again that there is another resistance block between 420 to 400, and then a final resistance block from 442 up to $443. This is the main area that I'm looking at, right? I do think by the end of this year, $500 will happen, but I'm not entirely sold that it's going to happen in the next couple of months. The short-term breakout, I think easy is 400, then best case scenario up to $430. And as we said, my plan is going to be rolling out my position as price breaks out. Now, I will keep you guys posted on when I do that. So make sure you hit the subscribe button if you're on YouTube, or if you're following me on X, make sure you hit the follow button because I will let you know when I'm closing my positions and when I'm rolling them. But one thing that I will also be doing, especially when we get up to that $400 level, is reducing my position size. So right now I have about $100,000 in call options on Tesla. If price pumps up to 380, I should be up about $35,000. So I'll go from like $100,000 to $135,000. If I roll that position, I'm not going to roll a full $135,000. I will take $35,000 off the table and then open up a new position with $100,000. So I'm kind of playing with house money. I still have exposure to the upside, but I'm not betting the house. And the last thing that I want to point out to you guys, it's not a flex, but it's just me trying to really show, risk management to you, is the fact that yes, I'm trading with a $100,000 position on Tesla right now, but my profits on Tesla just from 2023 is about $1.7 million. So I am trading right now with 1/17th of the profits that I've made on Tesla in the past 3 years. So even if this rejects, even if price goes to zero, even if I lose all of my position, it's not the end of the world. And that is the most important thing that I really want to push to you guys. In the past 3 years, we have taken over 200 trades on Tesla alone. 132 were winners, 76 were losers. Opportunity is always there. It's always in the market. And not even if it's just with Tesla. I'm constantly trading about 50 plus stocks at a time that are all meeting smart money criteria and our strategy. So don't think that you have to make money today. Don't think that this is the only opportunity that you're ever going to make money and you have to take all of your capital and put it into one position, because I can promise you that's not how you actually do this from a professional standpoint. You can see that with my shares, my average position is 2.5% of my account. That is it. I hope this video helped. As always, go check out all of our courses. They're completely free. All of our indicators, all of our charting courses. We even have courses on market psychology and discipline, which I think most people really need. And they are all free, no credit card, no fluff, no BS. The link to our entire strategy and course system is in the description.